Hey everybody, welcome to this free edition of our Trader Use Group Weekly Roundup for the trading week ending November 15th, 2024. I'm Preston Brent. Thanks for tuning in. Well, the theme, as you can see for this past week is the market's going to take a nap or is it going to go into a deep slumber? Well, let's just kind of review where we've been and we'll take a look at the charts and see where it looks like the charts are suggesting we can go. This past week, as you can see, everybody was in the red. Pretty good little downside week. Wouldn't surprise me. It gave back a portion of the previous week's gains. Some of it was accelerated with Boom Powell's comments on the Fed's desire to take its time in interest rate reductions, but a good part of it too was on potential policy implications for corporate earnings. As Trump is starting to nominate folks for his cabinet, we're getting areas like financials and energy shares. They're continuing to benefit a little bit from deregulation and merger approval. Healthcare, meanwhile, took a really big beating, especially with the prospects of RFK Jr. taking over HHS. That, I think, for those of you that are non-US based, that would be Health and Human Services, I guess. Anyway, reports surfaced midweek that Musk would also co-head a planned new Department of Government Efficiency called DOGE, alongside with Vivek Ramaswamy. So that'll be interesting. We also saw on the economic front inflation this week come in line with expectations. CPI was up 20 basis points in October. And core, which is you take out food and energy, it was up 30 basis points, due mostly to higher housing costs, if you will. Year-over-year inflation rose for the first time since March from 2.4 to 2.6, but all of it, even though it was up just a little bit, in line with expectations. Now, just understand, though, I think where we're starting to get the bond market very sensitive, interest rates very sensitive to the markets. You can see the 10-year yield on the right-hand side of the screen up 4.44%. We've got right now, in 2023, our interest expense on the U.S. deficit is $628 billion. In 2024, it's going to come in end of this year by $900 billion. And then we're currently running on an annualized basis now $1.2 trillion, and just interest only, not to pay down a debt, just to cover interest. That's insane. You're going to see the bond market start to react to that soon. And all the while, the Feds want to cut rates, which, is going to be real interesting. It's going to keep inflation up a little bit higher if they keep doing that. Another thing to think about, look at the PE ratio. Now, this is Wall Street Journal PE ratio. FactSet's PE ratios in the 22, 23 area. But either way, it's still very high. The current forward PE multiple has only been matched twice before at this level. That was in 1999 and 2021. And in both cases, the following year, the markets were negative. So just understand the markets are stretched a pretty good deal, okay? The other thing is that the expectations for a rate cut in December fell over this past week with Boom Powell's comments. It went from 64, a little over 64% to 58%. But then the expectations for a full 1% rate cut by the end of next year fell from 41 to 32%. So a little bit more, okay? We did see this week the U.S. Treasury, the 10-year, touched its highest level since the start of June. It was at 4.51%. It did close out the week at 444, but still very, very high, right? And you can see the best sector for the week was financials. The worst, healthcare, took a real big beating with RFK Jr. being nominated for Trump's HHS secretary. Cabinet head. Financials year to date are now in the lead, 34.14%. They love this market. A little bit of less regulation, interest rates steady, going lower. Healthcare is bringing up the rear, both of them in the green, but healthcare just barely in the green, a little over 5%. Okay. And then, of course, if we go over to the European area and just kind of go across the pond and see what's happening over there, you can see everybody in the red here too. Europe's been in the red several weeks running. They're basically, everybody over in Europe's keeping their hopes up that they can have a soft landing. We did get a second estimate of GDP across Europe, and they had a surprisingly strong 40 basis point expansion in Q3. And the European Union's projecting a growth of 80 basis points to round out 2024. Although Germany, they're expected to contract by 10 basis points. And remember, Germany is the strongest economy all over in Europe, so that's what's dragging most of Europe down. Over in the UK, their economy slowed a little bit. Surprisingly, their GDP came in at 10 basis points from the preceding quarter. They were expecting 50 basis points, so that's a big change from their consensus forecast. So all of Europe is just barely hanging on right now. Okay, you can see everybody was in the red for the week, and year to date, the DAX, the German index, is doing the best, a little over 14%. CAC 40, the French index, is still in the red, 3.63%. And then, of course, we go over the Asian markets, take a look at Nikkei, China, and Hang Seng. Let's look at Japan first. They were down for the week, 2.18%. Year to date, they're fairly strong at 15.46%. Their authorities over there warned that they could take appropriate action against excessive currency moves in the yen. Everybody seems to be playing the yen now after that August 5th debacle this past summer that gave us a 65 reading on the VIX here in the US and that unwind carry trade. So they're sensitive to movements in the yen right now. But anyway, the Bank of Japan, they basically said they're going to follow a path where they hope they can raise the rates gradually so that the rate will be at 1% in the second half of 2025 at the earliest. Now that they're very slow. I mean, they're very slow. Right now, I will point out that the yield on the 10-year rate is at 1.07%. So that shows you the markets are going to dictate the terms, not the Bank of Japan. And right now it's at 1.07%. And last week it was at 1%, right? Then on an annualized basis, we saw the Japanese economy grow 90 basis points in this prior quarter. That's down from the quarter before at 2.2%. So they are slowing down as well. Meanwhile, if we look at China, both them and Hang Seng were in the red for the week. Year to date, they're up. Primarily, China moved up because of all that stimulus they threw out into their markets. But there is still evidence of persistent deflation and worries about what kind of tariffs Trump's going to label on them. So there's that issue going on in China. We did see their retail sales expand a little bit better than expected, 4.8%. September's retail sales reading was 3.2, so that was up just a little bit. And their industrial production was up a little bit year over year, 5.3%, but that's still lagging their forecast. And in the real estate area, which is where China is really hurting, we did get a new survey from 70 of their cities on new home prices that fell 50 basis points in October from September, right? And in September, prices dropped 70 basis points from August. So there's the new home sale prices are still going down. 2 months in a row, so they're still having trouble with real estate markets. And even with all of these stimulus measures that they put out there to boost the housing sector, I think it's going to take through the summer of 2025 to really steady the ship over in China. And then again, that can all be unwound based on what Trump's going to do. He's going to be in the driver's seat as far as tariffs go. China doesn't have the economy to fight that at this time. I'm going to switch the screen right now, and I'm going to move you over to the markets. Let's just take a quick look. Right here, we'll take a look at the E-mini S&P 500 futures, which is where we always start. Take a couple of seconds to come up on your screen. And you're going to see here that we came right up to my original target, which was right around 59.66. And we moved up intraday to 6,053, right? Really a good high number in the futures market. And then as usual, we always pull back to my point of my original estimated point. Notice the 50 EMA is sitting here at about a little bit above 5,800. I think that can be our target. You can see my further pulled back target is sitting right at that zone right there at 56.58. And if we just kind of zoom out a little bit, you can see that gap in the E-mini futures. That was when they changed over to the December contract. But these gaps tend to get filled. Now, I'm not suggesting it's going to fill it as we go through the end of the year, because keep in mind from where we are now through the end of the year tends to be bullish, although we're seeing some profit taking. I don't think it's going to be too bad, but I do see us the momentum still carrying us a little bit lower, even if we have a little bit of a reversal of this past week. I do see the odds favor a little bit lower prices in the E-mini futures, right? And of course, if we look at NASDAQ, you can see NASDAQ's the same way, a little bit closer to the 50 EMA. We made our highs on November the 11th, all-time highs in NASDAQ. Having a pullback to the 50 EMA to me makes some sense. If we break it, the next line in the sand is 19,691 for NASDAQ, okay? Of course, if we look at the Dow, it fared the best this past week, although it was still a down week for everybody. You can see the Dow is off their November 11 highs. I think, again, the 50 EMA, it's north of, it can find a little bit of support there as it did right here, up, down, up, down. So a little bit more downside in the Dow as well. And then, of course, if we look at the Russell actually made almost all-time highs. You can see the all-time high was November the 8th. And if I just kind of stretch it out so you can see a little bit better, we came very close to the all-time highs on November the 11th. We came in at 24.55. All-time high was made on November 8th, 2021. And almost 3 years to that date, we came in almost at that number at 24.55.60. And then you can see this sharp pullback right here. I think it can also come down and test that 50 EMA. Wouldn't be surprised to see that happen, guys. So that's a little bit about what I'm seeing there. Now, of course, if we look at Bitcoin, that's the star this past week. Friday was up 43.40. You can see Bitcoin on November 13th made all-time highs, up 94,065 intraday. So when it gets this close to 100,000, although I don't want to say it's a given because nothing's a given in the market, 100,000 seems like the markets just want to go there for Bitcoin, okay? Just makes sense to me. If we look at the equal weight, SPX, you can see here again off the highs, settling in at the 50, so I can see that as well. Then if we look at the ratio of the equal weight to the SPX, you can see here this is just slowly in this regression channel moving lower. That means money is still flowing into the top 10 tech stocks and on a ratio basis greater than they are in the rest of the market. So again, I think this is going to change, not through the end of the year. I'm expecting, as I told our members, a mother of all bear markets, probably not in 25, although it may initiate towards the summer to end of 25, but I think in 26, it's going to get ugly. The deficits do matter. Our debt does matter, but momentum can carry us for a year or two longer, like it did in the late 90s before we had the internet bubble. This one will be a little bit different because at the internet bubble time, companies did not have revenue. We do have revenue now, but I think the bond market is going to make an issue of our deficit driving longer term interest rates in the 10-year up. 4.5% seems to be that magical area where once you get above that, the markets start to get a little bit squirrely to the downside, okay? If I come down here and show you treasuries, you can see the treasury market, it's just steadily moving lower. This is the 30-year bond. As this moves lower, well, guess what? Interest rates are moving higher. The lower this goes, the higher interest rates go because they're inversely correlated. The 50 just crossed the 200 right there on the 14th. Generally, when you have a cross like this, markets will come back and test that area, which is a zone here, and then it'll roll back over again. This is an Elliott wave 3 down, so you want to be a sell any rally in the bond market for the interim, okay? And then, of course, if I were to show the 10-year treasury note, same thing. We haven't hit the lows for the year, but we're definitely in the red for the year. And again, just going lower and lower. Any rally is probably going to be sold, right? If we look at currencies, let's look at the yen. I want it to go even lower. It's going to set us up for another long position. We got long way over here, and we rode this up. Notice right now. Let me just move it out a little bit so you can just kind of get a comparison of the two. You can see right here that I'd love to see this get a little bit lower. The Elliott wave count suggests any rally should be sold. So we're going to hold off until we get a clear signal. We get the 50 crossing the 200 to the downside. That may be a little bit of a magnet to give us an Elliott wave 4 higher, and then we'll watch a roll back over again. So I don't think the lows have been made in the end, but once it starts to settle in down here, we'll look at reversing our trade again, looking at going long. Look at the US dollar. It made new highs for the year. Look at that. It's a rocket ship. We're the only country on this planet where interest rates are actually moving much higher at a faster rate. Even though Boom Boom Powell, as soon as he cut the interest rates by 50 basis points in September, markets started going higher. You can see here there is no divergence, so that does suggest that other currencies are suffering as a result of the US dollar. So the US dollar made a new high for this year on November the 18th. And by the same token, we expect the euro to make new lows. And if we take a look at the chart here we go. We're hitting my target with the euro, which is right around 105. Right, this was a target I had up here quite some time ago. Any rally in the euro is probably going to be sold. We're getting the 50 crossing the 200 to the downside. Again, that could act as a rallying point for the euro currency, but I think the odds favor to roll back over if we do have a rally. Okay. And of course, if we come down here and if we look at gold, gold is selling off. I want to get long gold, but not right now, right? I think gold's going to come down a little bit lower. Any rally in gold is probably going to be sold off. It'll probably come down around the 2,400 area. If we can hit there, then I'd be interested in it. Remember, my original thesis was if it hits 2,600, get ready for a rally, but it's not. So now that it's broken, and notice the 50 EMA has got a downward vector to it. So this suggests there could be more downside with gold. And of course, silver is going to be the exact same thing. You can see silver's got a little bit of a higher beta, a little bit closer to 200 EMA. I think it's going to come down and test that also. Then, of course, we come to our oil trade. You can see oil is going to come back down and test the 2024 lows. Okay. Almost looks like a head and shoulder pattern right here, which suggests oil. If you look at my further dated target, it's going to be in the high 50s. That's where I'm expecting oil to go. If we can get down there, then I'll be interested in looking at along. Right here, it's kind of no man's land, almost like I said, looks like a head and shoulders pattern, which would suggest we got more downside and hence my target around 58.78 for oil. Okay. And then that gas, it just keeps fighting me. It wants to go up a little bit. I want it to go lower. Here's nat gas here. My target is for it to come back down over in this area here. And you can see this double top right here with a bearish divergence. So I would suggest, or I would suspect, we're going to have nat gas move back down into the red over the next 3 or 4 weeks as we get into the winter time here. So anyway, guys, that's a real quick and dirty and where I see the markets right now. Momentum should carry us a little bit lower into the week, and then we just got to see where more economic data comes out and just hope Boom Boom Powell stays away from the microphone. All right, everybody, have a really great week. Members, I'll see you for our weekly Market Watch Sunday evening at 7 p.m. Take care, folks.